But Earlypay, mate, tell us what it is.
Yeah, so look, Earlypay, it's by far the worst named company in my portfolio. This is the old CML group that does invoice financing for small businesses. So Earlypay, of course, you've had Before Pay come to the markets, and I think your first inclination when you see Earlypay is, oh, it's another buy now, pay later, but it's not. So these guys, if you're a small business and you've sold some goods to usually a larger business, and they may pay you on 60, 90, sometimes even 100-day terms before you actually get your cash. These are guys you can go to sell them your invoice, and for a certain amount, they use some AI in the background to calculate exactly how much. They'll buy your invoice off you, so you get cash up front in the door. So it's a very simple business. Factoring's been around for many, many years. Millennia maybe, and they do it well. So this is a business, like I said, used to be CML Group, been listed for a long time. It was doing very well until COVID. So if you look at sort of their net profit up until COVID, it had just grown steadily year on year from sort of 1 mil up to nearly 10. COVID hits, of course. COVID, in hindsight, I think COVID's been such an interesting time because at a total societal view, I think we've sort of gotten through COVID not too bad compared to what you maybe would have thought when it sort of first hit. But at a micro level, and particularly small business in Australia, there was some big hits. And looking back, that's probably the biggest paradigm shift we've had through COVID. I think a lot of power or split between small business and big business shifted to big business, who were larger, better access to capital, better access to survivability through COVID. And you've probably seen that impact a small business, which fingers crossed can come back strongly. But nonetheless, these guys exposed to small business. So that profit really stagnated through FY20, FY21. And then I think we're finally seeing that, big pent up snapback from COVID. So this first half result, out of the three I've brought, and even probably my whole portfolio, it was by far the best result I'd seen. So these guys did just over 7.5 mil net profit, which is basically, they did 8.5 mil the whole of last year. So a very, very strong first half result. They upgraded their guidance, and it was the third time they've done that. So when they first came to market at the end of their FY21, they said, we think we'll grow about 40% profit in FY22. At their AGM, they then changed that to, we think we'll do 50% profit. And then now they've come out and said, we'll do, 15 mil, which is roughly about 70% profit. So you're seeing the momentum of this business increasing very strongly. And again, it comes back to, you'll probably see this consistent theme across the three companies I've mentioned, and you see it across most of my portfolio, but, conservative, competent management teams. So, despite doing over 7.5 mil in the first half, and second half is generally seasonally stronger for them, they've only guided to about 15. So it's not hard to see they'll probably end up beating that guidance again quite well. And I'm sort of modeling out maybe somewhere between 15.5 to 16 million at the end of the day. Only currently trades on about 130 mil market cap. So this is one for the deep value out there. This is like sort of, probably 8 to 9 times earnings, with very strong growth. Again, dividends, cash flow. You'll see that consistent theme across pretty much everything I talk about, I suppose. So that core business is where all the growth's coming from, that invoice financing business. It grew 24%. It had some good control over their expenses, which only grew 21%. As they get bigger, and you see this with a lot of finance companies, like if you were to look at maybe a MoneyMe, a Wiser, some of those guys, as you get bigger, you can negotiate better terms with your lenders. So their cost of interest is coming down. It widens that operational leverage even more. The reported numbers, they had the benefit of a lower tax rate, which will normalize, but even stripping out the tax effect, still grew sort of 35%, which is really strong.
How about sorry, Luke, how about the things like losses and their their risk management?
Yeah, it's a very good point. So again, it's always important for a business like this. So this is a business where you've generally got a very strong asset backing the lending. So you've got an invoice that's already been created. Like I said, usually for a larger customer, and so their loss rates, they say they're sort of less than 10 basis points. So it's not a business that has to manage. So when I compared it to a MoneyMe or a Wiser before, those guys are direct consumer finance. That's a space where I'm a little bit wary on that space, because I think you've been through 2 years where consumers have been quite subsidized by the government and consumer balance sheets are quite healthy. Yeah. So I sort of take their loss rates with a little bit of a grain of salt. But for these guys, the quality of those assets that are backing the loans, I think, their loss rates have never been a big issue for them. Because keep in mind, they're not financing the small businesses directly. They're just financing the receivables that they have. So even if those small businesses are struggling, that's still a legal claim they have to the receivables on another customer that they've issued that to. So, they do have one thing I will call out. And again, I was talking about XRF before and sort of how you ascribe value as an investor. They do have a direct equipment finance book. So that's one where if I'm actually my wife used to run a cafe. We have a cafe, we have our coffee machine, costs a few $1,000s. You can get that financed and just have lease payments instead. So that's one of their segments. That's one that I'm not as fussed about, to be honest. It's an area that the history of the ASX is pretty checkered. You might remember Silver Chef a few years ago.
Of course.
Access Today popped up for about a year in that same space before they blew up pretty spectacularly. Because you're exposing yourself much more to the underlying health of the small business that you're servicing. They need to be able to service these equipment financing, but it's a very, very small part of their business, and by far the earnings engine is driven by that core receivables business, which I think is doing really, really well. So look, like I said, I thought it was one of the better results I saw. It was just an explosion of organic growth. A lot of that I think is just pent up COVID demand, but management have sort of said they've seen the start second half 22 continue. As they get bigger, they're able to, the constraints of their growth sort of get removed, because they have warehouse facilities with their lenders that can only lend up to a certain amount. They expand, so they can now grow faster. And they actually only announced that the other day, I think yesterday, that they'd increased their warehouse facility. I think, again, it's a very well-run business. You need that. Anytime you play in the finance space, I think you've got to have a really strong view on the management team and their conservative nature, because lending is such a tough business. Bear in mind, again, we'll get into the weeds a little bit here. I'll try and keep it a little bit high level, but when you lend a small business or a consumer money, the profit you recognize up front is effectively what you want it to be. So the accounting standards essentially let you take a predicted loss on that, and then across your whole book, whatever's left is your reported profit. So always keep that in mind, that you've got to have a strong view on how management approach their book, how they're lending. Fast growth, even though I've been talking about Earlypay growing fast. It's incredibly easy to grow fast as a lender of money. All you have to do is give people a lower interest rate, and you'll generally grow faster than your peers. But it means you're taking on potentially more risk. But again, I've known this management team for a long time, spoken with them, and followed them for a long time. I've got a lot of comfort around their competency and how they grow their loan book and their business, and you see that in the historical results as well. So I thought it was a fantastic result. I think they'll come out and actually beat that guidance that they've put out to the market, and probably trade on maybe 8 to 9 times earnings with some good growth. The big risk, I suppose, and it goes into what you were just talking about with National Tyre, is the underlying exposure to small businesses in Australia. If this is a double dip recession, we've already seen what COVID did to their volume numbers and their profits. That similar thing could happen again. So bear that in mind. Again, it goes back to what I said. I don't invest because of macro, but for a position like Earlypay, you have to be aware. You have to sort of have your finger on the pulse of where you think the economy is at any one time, roughly, and maybe even more specifically, the trajectory. Are things doing well? Are things maybe starting to turn? What are the headwinds? And for these guys in particular, for small business. But putting them to the side, I think the valuation you're getting, I think, compensates you for all that risk and then some.